Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite our market master for the morning, S. Naganath, President and Chief Investment Officer of Franklin Templeton Alternate Investments. Incidentally, Franklin Templeton is in the process of launching their alternative investments vertical as well with their maiden fund, Franklin India Long Short Equity AIF. Good morning, Naganath. Welcome.
Morning.
And
Thanks.
all the very best in your new avatar. You're dropping into the studio the first time in your new role.
Sure.
It's interesting, an alternate investment fund at a juncture like this where there seems to be a churn.
Sure.
So at the moment, what are the short candidates? It looks like everything is long. Banks are also rising. IT and pharma are also rising.
Well, I think, I anticipate a fairly elevated volatility in the markets in the next 12 months or so globally, and to that extent, we'll also be affected by it. I think the reasons are not difficult to ascertain at this point. You have, on the one hand, higher interest rates from the Fed and other central banks around the world. You have a retraction of the excess liquidity that was infused into the system in the last 8-9 years. You have the specter of higher inflation. And most worryingly, I think the trade tariff issues, continue to linger. And I feel the markets are a little relaxed about it, even though there is talk of, some of the discussions that could potentially put a rest to this issue. The fact of the matter is, it could also intensify. So we don't know for sure. And I think these are issues which, if they simmer for too long, will continue to inject a lot of volatility, especially in the currency markets, because we could have competitive depreciation of currencies. We've already seen that, in the last couple of months. And therefore, my worry is currency volatility then eventually spills into bond markets and then into equities globally. And that could potentially be a big headwind for equities.
Okay, Naganath, good morning. So in that case, do you think this rally that we have seen, especially in corporate banks, that is also at risk? And it's a significant rally that we have seen.
Well, as far as Indian equities are concerned, I think the earnings growth momentum appears to be fairly positive, right? Compared to what we saw in fiscal 17 and fiscal 16. Fiscal 18 at about 15% earnings growth has been quite encouraging. The results for the first quarter of fiscal 19 have also been fairly encouraging. So the estimates I see today are about 20% earnings growth. Even if it does come in at 15 or 17%, that's a big improvement from the trend we've seen in the past 3 or 4 years. So that's a big support for equities. But we have to be watchful of the headwinds I talked about. And given the fact that in the last 5 years, your P multiple expansion has been faster than the growth we have seen in earnings, does lead me to be a little cautious that if you do have some of these international factors weigh on P multiples in a short duration of time, that can cause a downward bias in prices, even as earnings improve and eventually support those valuations.
So this 20% earnings growth is for FY19, or you're forecasting it for FY20 as well?
Right now, it's FY19.
Okay, for FY19, fine. Naganath, morning. So the biggest talking point, of course, has been the fall in the rupee, right?
Yeah.
How do you play that? Do you look at it as a tailwind for IT stocks and buy into them, or would you worry about the macros?
I think, again, in terms of currency depreciation in the emerging markets, I think we are just about seeing the early signs of that. We have to see to what extent China moves on the yuan. We've already seen a 6-7% depreciation in the last 2 months. And if the trade issues are not settled soon, and they continue to simmer, like I said, some part of it will spill over into the currency markets in the form of more depreciation. So obviously, emerging market currencies and also the rupee will respond to that. So in isolation, if you say the rupee has depreciated, exports should increase. We have to look at it in the context of what other countries are doing in terms of their currency depreciation also. So if everybody depreciates, then, the incremental growth in exports may not necessarily happen, right? So we have to look at it. And we can only make a judgment about this maybe 3-6 months out.
Now, in your long short, sectorally speaking, what is the long short?
See, there is nothing fixed about these things, The long and the short positions, most of it is tactical, opportunities that you look at month to month. So it keeps changing from month to month.
So at the moment, are PSU banks in the long camp?
Well, I think overall financials, which is a large weightage in any bellwether index and also many portfolios, if interest rates continue to move up, if you have currency volatility, that actually sparks a higher increase in rates, even if it is temporary, that could be a big headwind for financials. So in that context, one needs to be a little cautious there, especially given high valuations for many companies there.
In terms of risk, there are of course global risks. There's local risk as well this year in terms of politics and other risks. So you reckon that this year perhaps we'll have to adjust our expectations compared to last year?
Well, I think as far as growth is concerned, I'm quite optimistic that we will do certainly much better than 7%. Which in itself is a great level of growth compared to other emerging markets. Consumption continues to remain a very strong theme, and will continue not just for the next year but beyond. Investments, we've often talked about the very slow growth in private capex, which I think will revive probably after about 12 months or so. But government spending has been quite robust. So I think from a growth point of view, from an earnings growth point of view, I'm quite optimistic. It's just that in the near term, I would say the next 3 to 6 months or till the end of the year, we have to watch these international cues, because these tariff issues is something new for the market globally, right? Okay. And the extent to which it hampers global trade, dislocates certain supply chains built over the last decade or two, all that needs to be watched carefully.
Okay, by the way, the mid-cap index is picking up quite a bit actually. So up 0.7% right now. Very strong market breadth is what we're staring at. Almost 1,400 stocks on the advancing side. And once again, it's consumption. So names like Imami, etc. topping the charts this morning. Berger Paints hitting new highs. Naganath, I guess what Lata was trying to do was get your sectoral bias. And I'm going to press that a little further because I was looking at one of your notes. And you say that investors could look at Telecom with a time frame of 2 years. I mean, this is a space that has been beaten down quite a bit, right? So much pricing pressure. You think the worst is over here? And would you look at most of the incumbents or just the larger names that are causing disruption like Reliance?
So eventually the pricing issue has to be resolved at some point. It might still take another year or so. But if you do have the patience to buy and hold some of these stocks over a 2, 3 year, 5 year period, I think, given that they have all corrected significantly, I think there could be fairly good upside there. The same is true of some of the larger PSU banks, where I think the customer franchise is phenomenal. And I think we are past the high point in terms of loan loss recognition. So from here on, again, if you do have the patience to hold these stocks for, say, 36 months and beyond, I think the upside could be quite interesting.
6 months and beyond.
36 months and beyond.
36 months.
Yeah.
Okay. Well, what about the private retail lenders? I mean, the HDFC banks, the Kotaks. I mean, they have. Would you say that some money will be taken out of them because they were the winners when the corporate lenders were lagging?
Well, they've done extremely well, and I think pretty much investors are overweight, I would say, in many of these names. So they will continue to compound at a healthy rate. But in terms of relatively better gains from a purely appreciation point of view, I would say one could look at the larger PSU banks in this context.
And what about metals? Today, it is their day under the sun, as it were, because LME prices were all higher and the rupee advantage is at the moment at least getting factored in by the markets, rightly or wrongly. Is there a longer play there?
Well, I'd be a little cautious here. For one, the dollar continues to get stronger, and a stronger dollar typically tends to be negative for metals. The second is, if you look out maybe the next 24 months, if, like I said, the trade issues continue to linger on, what are the chances that eventually it leads to a slowdown in global growth, right? Now, nobody's really focused on it just yet, but supposing they do, come into the central or mainstream viewpoint, maybe after 6-8 months. So from that standpoint, I think I'd be a little cautious on metals until, the trade issues are sorted out.
So you like pharma, and, some of these stocks have recovered quite a bit from the lows. But what's happening here? Because most of the big pharma companies still indicate that margins are under pressure because of higher R&D expenses. Nobody has changed their guidance. Pricing pressure still exists. What has changed over the last 2 months?
I think there's been some bargain hunting here because of the decline in prices. It's quite feasible that from an operational standpoint, maybe things improve only after about 6 or 9 months. So you had a bounce. Maybe, if the market as a whole tends to drift, these stocks could again go back down before you have a nice move up, maybe after about 6 to 12 months. Okay. So again, if you do have the patience to hold it for about 12, 24 months, maybe you can do some buying now, some more later, maybe after 6 months.
Would you say, Naganath, I mean, since you look at several asset classes now, that equities, you know, there can't be much of a downside, even if there are electoral reverses or at least, you know, temporary setbacks, say, if there are state elections or whatever, because other asset classes have really nothing to offer. Gold, land have been comatose for so long now, and bonds as well, especially if it's going to be a rate hiking cycle.
Sure.
So do you think equities have something good going?
No, certainly equities have compounded very well in the last, you know, many, many years. Despite significant market corrections, be it 2008 or to some extent 2011, 2013, etc. So again, if you're a long-term investor, you take a 5-year view, you can buy today and it will compound quite nicely, in a relatively better compounding than what you could get possibly in fixed income. But if you are having a shorter time duration, you know, 12, 24 months, all I'd say is there are some air pockets along the way in the next 12 months or so, largely global in nature, that we have to pay attention to. Domestically, I see no reason to worry about the growth rate for the economy or, for that matter, corporate earnings.
No, my question was, therefore, is the downside protected since other asset classes are offering no competition? Even if these air pockets, the equity markets get into these air pockets, the downside is limited.
Well, you know, in absolute terms, you could still see correction. And if that correction is, you know, 5% or 10%, a typical investor often frets over it, even as the long-term compounding is good. It's just that, you know, they feel they could have bought it a little cheaper. So if you are able to internalize that there could be potential downside, be it 5% or 10% in the next 12, 24 months, but I'm going to do fairly well relative to other asset classes in the next 2, 3, 5 years, you know, you can buy today and not worry too much about it.